when the market turns cold and the wave dies down, what you usually see, a lot of people lose multiples of what they invested in because they borrowed money. And this is how families get destroyed. This is how lives get ruined. When I was growing up in Russia, the very first time I think I've seen anything that was even remotely related to the stock market was Traded Places with Eddie Murphy. And there was this scene when I think they trade orange futures, and there's papers flying and there's all this yelling. And that was that's what I thought investing is, right? That's just a whole bunch of people doing fast trading with each other. And that's how basically anybody who grew up in Soviet Union, that's what their perception of investing was. As I learned more about investing, I realized it's so far removed from that. What investing is, imagine if there was no stock market, okay? If you were buying a business from somebody and you had to figure out how much you want to pay for this business. Okay, you would look at the business cash flows, who runs the business, the management, many different factors that are where you would have a perspective. You would be looking long term, 5, 10, 15, 20 years out, right? Because when you buy a business, usually it's not easy to sell it. So therefore, there is a commitment to it. Okay, that's what investing is. Now, the stock market allows you to buy and sell a stock in milliseconds. Okay. That's a feature and a bug at the same time. It's a feature because it removes tremendous transaction costs. You can change your mind, whenever you want to. Now, the reason it's a bug because a lot of people, they start treating stocks as a gambling vehicle. Okay. In other words, a lot of people do more research when they buy a dishwasher or a car than when they buy a stock. Okay, because they know they can always sell this, 5 minutes later. Now the problem is the stock prices in the short term, their movements is completely random. So if you're buying stocks, if you buy a stock just to sell it tomorrow or in 20 minutes, you're not investing. You're gambling. You're just basically riding this random roller coaster given to you by the stock market. What investors do instead, they take advantage of the ability to buy a company at any point in time with very low transaction costs. But the attitude of analysis as if they were buying a private company, as if they were going to own it for a long period of time, knowing that facts may change and facts may change, etc. And they may have to sell it sooner, but the attitude they have the attitude they bring to investing is as if I'm making a decision for a long period of time. I would argue that the instant liquidity of the stock market for a lot of people is poisonous. Because what they start doing, they think they're investing. They're buying real companies. But in reality, they're gambling. Except when you go to the casino, unless you're a degenerate gambler, you're just bringing as much money as you can afford to lose. If you start treating the stock market as a casino, most people bring their 401ks and their retirements and their kids' wedding. That's not the money they can afford to lose. Okay. What also happens when you invest, especially when you are participating in the stock market and you think you're investing but you're gambling, if you happen to ride a speculative wave like what we had in 1999 or we had over the previous couple of years, it seems like every decision you make, you get an instant reward because you bought a stock, you know nothing about the company except maybe you know the ticker of the company, and it keeps going higher, and you feel like you got it figured out, and God forbid you actually start borrowing money, you start taking out home equity loans or margin loans, and you don't recognize you're actually gambling, you're taking huge risks, and you were just lucky that you got on the wave of the market is going up. When the market turns cold and the wave dies down, what you usually see, a lot of people lose multiples of what they invested in because they borrowed money. And this is how families get destroyed. This is how lives get ruined. And so that's why I think the stock market can be very dangerous if you are not investing but gambling in it. I think the cost of being wrong when you invest in index funds, and I'm talking about diversified index funds, is much less than if you are treating the stock market as a casino. Because I don't think many people borrow money against the house to buy index funds. Maybe some do, but that's not a typical behavior. I don't think it's gambling per se. It's just basically saying, I'm just going to buy the largest, let's say 500 companies in the United States. I don't know anything about how much they're worth. I have no judgment about this. I'm just basically going to invest in the US economy or global economy at any price. Okay. Now, the problem is that how much you pay for that. If you look at the S&P 500, this is what we're referring to. We're talking about S&P 500 today is a very, the average stock there is very, very expensive. So the cost of being wrong for you just buying a kind of a broad market index is that you probably are not going to make money for the next 10, 15 years. It's not as bad as losing, 80% of your life savings by gambling. But at the same time, the result is still going to be very unexciting, just less dramatic.